It's a cold grey Wednesday in early autumn, and London has never seen anything quite like this. Behind the city's ordinary morning routine, a financial war is unfolding. The pound is under attack, the British government is scrambling, and the Bank of England is about to lose a battle it cannot win. This is September the 16th, 1992, a day that will later be called Black Wednesday. In the trading rooms, the first warning signs are already on the screens. The pound is drifting, not collapsing, not yet, just quietly, persistently slipping in the wrong direction. The kind of move seasoned traders notice immediately and never ignore. By the end of this day, the British government will have spent an estimated £3.3 billion. Interest rates will have gone from 10 to 12% in a single morning, and one of the most significant days in post-war British economic history will have ended in a complete failure. This man already knows how it will end. On the morning of the 16th, he's a nobody. By the morning of the 17th, everyone knows his name. To understand how one man did what an entire government could not prevent, you need to understand what actually moves exchange rates. And this is a story of George Soros, the British pound, and how exchange rates actually work. So let's take a closer look at what happened that day. When London opens, the sterling is already under pressure. Britain is legally bound to keep the pound at an exchange rate above 2.773 in comparison to the Deutsche Mark. That's the ERM floor, the lower limit of the band Britain had signed up to. We'll come back to what the ERM actually was in a moment. For now, the important thing is, falling below that line was not optional. It triggered an automatic obligation to intervene. So the Bank of England starts buying pounds immediately. Before 8:30, 2 orders of £300 million each. The selling doesn't stop. An hour later, the bank is still buying, the reserves are being spent, and the pound is still drifting. Not collapsing, not just yet, but moving in the wrong direction. The market is absorbing every pound the bank buys and sells more. At 11 a.m., the government decides to escalate. Rates are raised from 10 to 12%. The logic is straightforward. Higher rates make holding pounds more attractive instead of selling them. Briefly, the line on the chart flattens. Then the selling resumes. The market doesn't think 12% can last, and they're right. By the afternoon, it's clear that intervention and a rate hike have not been enough. The pound keeps falling. The ERM floor at 2.773 is now clearly in range. Confidence in the defense is collapsing. Reserves are running low, and the selling pressure is not letting up. At 4 p.m., a second escalation. 15% is announced. In a functioning economy, a move like that would be extraordinary. Here, traders price it as desperation, rather than resolve. They know, and the government knows, that 15% in a recession is not something Britain can live with. The rate is never actually implemented. It's announced and then quietly abandoned later that evening. At 7 p.m., Britain suspends its ERM membership. The defense is over. The pound is free to fall. Rates are cut back to 10%, lower than where they started that day. £3 billion spent for nothing. The pound has broken through the floor that Britain was legally obligated to defend, and somewhere in New York, George Soros is closing his position with over $1 billion in profits. The next morning, the front pages say it all: Black Wednesday. The 15% rate was announced but never took effect, and that detail, quietly buried in the aftermath, tells you everything you need to know about how the day actually ended. The government had already given up before it said so. The market knew before they admitted it. So why could the market beat the state? To answer that, we need to go back before the crisis and look at the system Britain had tied itself to. In October 1990, Britain joined the European Exchange Rate Mechanism. The ERM was a precursor to the euro. Member currencies agreed to keep their currencies within a fixed band against the Deutsche Mark. For Britain, the central rate was 2.95 to the pound, with a lower limit of 2.773. If sterling fell below that line, the government was legally obligated to intervene. No discretion, no exceptions. An obligation under treaty. Britain joined to signal credibility and commitment to European monetary stability. Almost immediately, the conditions that made that rate defensible started to deteriorate. And basically, a pegged exchange rate is a promise. And this promise can only work if the market believes that you can actually keep that promise. And that was Britain's problem. The ERM demanded high interest rates to keep sterling within the band, but the domestic economy was in recession. Unemployment was rising. Millions of homeowners were on variable rate mortgages. Every hike increased their monthly payments and deepened the crisis. You could defend the currency, or you could manage the economy. You could not do both. Soros understood this before the government admitted it. Then came the German reunification in November 1989. While it was one of the greatest political moments of the 20th century for Germany, from the perspective of British monetary policy, it was the beginning of a very serious problem. Reunification was expensive. The Bundesbank raised rates from around 6 to nearly 9% to contain the inflationary pressure of absorbing East Germany. At the same time, Britain was trying to cut rates as well to relieve its own recession, and it did cut slowly from 15% down towards 10%. But here's the problem. As the two lines converge on this chart, Britain's room to maneuver is shrinking. Cut rates too fast, and capital flows towards the Deutsche Mark. The pound weakens. The ERM floor comes into range. Britain was not forced to raise rates. It was prevented from cutting them as much as the economy needed. That is a trap. And this is what happened when the trap finally closed. On the 16th of September, rates go from 10 to 12% in the morning. 15% is announced in the afternoon, and then quietly abandoned the same evening. And the moment Britain leaves the ERM, the line collapses, down to 10%, then lower. The rate cuts Britain had needed for almost 2 years, they happen immediately once the conflict is gone. That drop isn't a crisis. That drop is a relief for the strained British economy. So that was a trap. Now let's look at why the market knew it was unsustainable, and Soros knew before anyone else. He didn't have inside information. He had a framework. The first driver is relative inflation. The general concept is, when a country runs persistently higher inflation than its trading partners, its exports gradually become more expensive abroad. Real purchasing power erodes, and eventually the market reprices the currency. It's slow, it's structural, but it's directional. It only goes one way until something adjusts. Applied to Britain, throughout the late 1980s, the UK ran significantly higher inflation than Germany. By the time Britain joined the ERM at 2.95 marks, that rate was politically credible, but it was not grounded in what British inflation had actually done to the pound's real value. The fundamentals had already moved. The nominal rate had not. That is the gap Soros was looking at. The official exchange rate was being held in place by policy. The real purchasing power of the pound had been shifting underneath it for years. Defending the nominal rate required ignoring the real one. Markets don't do that for long. The second driver is relative interest rates. When rates rise in one country, global capital has a reason to move there. Investors buy the currency to access a higher return, which pushes the currency up. At the same time, lower yielding currencies can weaken as money leaves them. That is why one rate hike can put pressure on other central banks to follow. But it only works if markets believe those higher rates can last. And that is exactly why 12 and then 15% did not save the pound. The domestic economy was in recession. An election was coming. Millions of mortgage holders were being squeezed with every hike. And the market was not ignoring the arithmetic. They were pricing politics. And the conclusion was Britain could not live with these rates for long. The third driver is reserve capacity. A central bank can buy its own currency to defend a peg, but its firepower is finite. If the market believes the defense will eventually run out, reserves stop being a shield and start being a countdown clock. The Bank of England had roughly 44 billion in reserves. Soros alone was short around 10 billion. With other funds and banks joining the trade, the combined selling pressure exceeded what the bank could absorb indefinitely. The defense wasn't just difficult, it was arithmetically doomed. The fourth driver is expectations. And this one is different from the others because it doesn't just predict outcomes, it can help produce them. The more investors expect sterling to break, the more they sell it. The more they sell it, the weaker the peg looks. The weaker the peg looks, the more others are inclined to join in the selling process. That is what Soros called reflexivity. Markets don't just observe economic reality, they participate in creating it. The belief that the pound would fall generated selling that made it fall. The fundamentals made the trade logical. The market dynamics made it inevitable. So, to put it together, four drivers, each working on a different timescale. First, inflation eroded the real value of the pound over years. The entry rate simply was wrong before the crisis even began. Second, the interest rate differential trapped Britain between defending its currency and managing the economy, a trap that tightened over months. Third, the finite reserves of the Bank of England turned the defense into a countdown. And last but not least, expectations made the collapse self-fulfilling. The moment enough people believed it would happen, it did. Each of those factors alone might have been manageable. Together, they made the position indefensible. And this would not be the last time this occurred in history. Thailand, 1997. The baht had been pegged to the dollar while Thai inflation went higher than in the US. To defend the peg, the Bank of Thailand kept rates high in a slowing economy, the same trap as in Britain. Speculators attacked, the central bank spent its reserves, the selling exceeded what it could absorb, the defense collapsed, and the crisis spread across Asia. Once the market concluded the peg would break, it broke. All four drivers, same sequence. Then, in Argentina, 2001, the peso had been pegged to the dollar since 1991. It worked until inflation made that rate unsustainable. Unemployment was above 20%. The government still couldn't cut rates. The peg demanded austerity. The economy couldn't survive. Reserves spent, firepower gone. When it broke, the peso lost 2/3 of its value almost overnight. An interesting case is what happened in Switzerland in 2015. The Swiss National Bank had been capping the franc against the euro since 2011, buying billions monthly. By January 2015, the balance sheet had swollen to nearly the size of buying the Swiss economy itself. On the 15th of January, without warning, the cap was abandoned. The franc gained 30% in minutes. No inflation story, no rate trap, just finite reserves, and the moment expectations flipped on their head. 3 different countries, 3 different decades, 3 different directions, but the same logic every single time. When a government commits to holding an exchange rate that the underlying economy can no longer support, the market eventually tests that commitment. And if the fundamentals are wrong, if inflation has eroded real value, if interest rates are unsustainable, if reserves are finite, if expectations turn, the market wins. It always wins. That is what Soros understood in 1992. Not some secret about the British economy that nobody else knew. He simply looked at the fundamentals clearly, without the political constraints that prevented the government from doing the same. The pound was overvalued, the position was unsustainable, and he bet on exactly that. Exchange rates are not just prices, they are tests of credibility. And on the 16th of September 1992, Britain failed that test. Thank you for watching and have a nice day.